Earlier this morning, Canada's banking regulator said that the domestic stability buffer will be substantially increased in October. That is essentially a rainy day fund intended to encourage banks to save capital when times are good, to lend it out when times are more challenging. We're joined now by an expert in the banks. He is Rob Wessel. He's a former Bay Street banking analyst. He's now with Hamilton ETFs, and he joins us right now to talk about this move from OSFI. Rob, thanks for joining us. What kind of message is OSFI sending by making this announcement?
Yeah. So first, thanks for having me, Paul. I don't think I think we're really just going back to normal. I think the announcement to normalize the buffer was largely expected. Maybe it's a little bit higher than the market had expected or might, but it's not really going to affect bank stocks. I think at really the substance of this is to increase the sort of de facto minimum capital levels, and the implications to that really impact the market's expectations on buybacks, acquisitions, dividends, things like that.
Right. So those de facto minimum capital levels, in my understanding, go from 9% to 10.5% when this change takes place on the final day of October. Correct?
Yeah, I think it's 11.5, but either way, it's the current levels are 12.8. So they're way above that. And I think the other important point to make is not only is the minimum capital level, the absolute level of capital, it's never been higher. There's significant upward pressure on that. The capital ratio is called Common Equity Tier 1. It's 12.8. It's never been higher. It's been moving up about 30 basis points, give or take, a quarter. And that number is probably headed to 13.5, which is just a huge number. So I think OSFI probably looked at, the current timing and said, now's the time, given the banks are so flush, to just nudge up this minimum level or normalize it. Nobody will notice. It won't have any implications on bank stocks. And really, probably the biggest impact it'll have is it'll limit the amount of cash that banks can use when they make acquisitions, at least those ones that want to make acquisitions. But it's not likely to have any impact on dividends at all.
That was my next question. Canadian bank investors are waiting for the prohibition on dividend increases, also imposed by OSFI last March, to be lifted. Many people in your world expect that lift to come in September or so of this year. Is that your thinking?
Yeah, I mean, it's kind of silly that they're not allowing dividends right now. If you think about it, the Canadian banks have never made more money. They made $14.5 billion last quarter. That's the all-time high by a pretty meaningful margin. Capital last quarter was never higher, and yet they weren't permitted to increase dividends. It's a bit silly, but nevertheless, at some point when they are allowed to increase dividends, the increase will be that much higher. And so last quarter, the $14.5 billion was about 15% higher than it was when the cycle started. So I think everybody's baseline should probably be somewhere between 10 and 15% increase in dividends. I'd also point out that $14.5 billion is likely also headed higher. So, right now the banks have not only a lot of capital and a lot of earnings, but because their balance sheets are so strong and the reserves are so high, those numbers are likely to push even higher. So there's a lot of flexibility here, which I think is why OSFI probably took this moment now to make this announcement.
Your company, Hamilton ETFs, last year launched a new Canadian bank ETF with modestly magnified exposure to the bank stocks. And at that time, when I talked to you about it, you said timing was really everything in the launch of the ETF, that you were doing that because you and your colleagues saw the banks moving through a credit cycle that was not going to be as nearly negative as had been feared at the beginning of the pandemic. In other words, loan losses would be more modest, and eventually we would get to the point where banks would start releasing money from earlier booked loan loss reserves back into the profit stream. We've started to see that. How much more does that trend have to play out?
Yeah, so thanks for the reference. So the ticker is HCAL. So in October, we said that the loan losses had peaked and that you were now entering the recovery part of the cycle. And so, yes, we did launch a very moderately levered Canadian bank ETF, which we hoped would have longer or higher long-term returns as well as a higher dividend yield. And definitely one of the reasons that we predicted that the cycle was entering the recovery period at that time in October was that the amount of money the banks had set aside against loans that were still performing was about $25 billion. And the new accounting treatment introduced this balance, and it was just a huge number. And basically what we were saying in October was that's enough, that they've set aside enough money. And so we did predict that reserves would start to be released. This amount would start to normalize, meaning the amounts that were set aside would go back through earnings and back into capital, which is sort of informing what I was just talking about a moment ago. We think, there was $2 billion released this quarter, so the banks effectively had no loan losses on a net basis. We think there's probably another $4 to $6 billion to go. I would expect that, or we would expect that loan losses will be close to zero again next quarter, and they might even be negative in Q4. So, again, you're back to lots of capital, lots of earnings, and it's giving the banks some optionality. They can either make acquisitions, probably a few of them will announce large buybacks at some point when we have a new head of OSFI. But I think, at the end of the day, the balance sheets of these companies have never been bigger. They've never made more money. And not only that, there's still pretty significant upward pressure on both.
You've referenced acquisitions a couple of times. Do you expect the Canadian banks to go on a buying spree, perhaps in the United States?
Well, I think it depends on the bank. So, the Canadian banks, as we all know, have been, have had a capital deployment strategy for the better part of 20 years. The first 10 years, it was mostly consolidating the domestic market. The last 10 years, give or take, maybe 15 if you want, has been consolidating deploying capital outside of Canada. I think, probably, Royal and National focus on more growth organically and reinvesting within their current, portfolio of companies. TD has continually talked about making an acquisition, yet you still haven't seen one. And then BMO and CIBC, it could go either way. Probably more somewhere in the middle. But I do think, and Scotia, I think, is more likely to do buybacks. So I do think the banks that emphasize buybacks and capital return in the next 12 months will outperform those that focus on acquisitions.